The fight to inflation is a tough fight, and I think maybe the difference versus previous years is the central bank's only mission right now is fighting inflation and maybe less focus on not hitting the economy.
Yeah. But what does that mean, though? Because, as you say, we've got mixed macro indicators coming in. The market doesn't really know how to price in what the Fed are going to do next, whether they're solely focused on inflation. But remember, the Fed have a dual mandate. They also have to think about maximizing the employment rate as well. So one of those two pillars is going to have to be forsaken. But right now, the focus, the drive is very much to bring inflation back to target, which means that inevitably there is going to be a macro impact on the economy, isn't there?
Yes, but that's almost what the Fed needs to do and wants to do. I think we need to accept short-term pain, potentially to have a brighter future for the economy.
Yeah. So what are you thinking in terms of asset allocation then? How do you play this market? We've seen a lot of volatility. Last year was very challenging. This year started off with good footing, and now again, markets are beginning to reassess what we go from here in terms of rate hikes.
Yes, I think the big surprise last year was bond is back from a, if I may say, boring asset class. Today we have a much more interesting and exciting asset class with higher yields, and I think it's not only interesting for institutional kind of clients but also for private clients. So you need to look at asset allocation with bond in mind. Even to a certain extent, cash is also an asset class again. Now, I won't look to everything of fixed income. I would personally favor credit, good quality credit, and I would even dare to set foot in the high yield segment, but maybe only with the best-in-class double B. We tend to favor that sweet spot, like we say, the crossover, because you can get a pickup in yield without adding much risk. Other asset classes, we also look for resilience, how to invest our clients' money, favoring opportunities, but also protecting in case of downturn.
I want to come back to what you were saying about bonds and bonds coming back again, because a couple of weeks ago we had other analysts come on the show and they say, well, if the trajectory of inflation is downwards and we know that this disinflationary process has begun, therefore the logical conclusion is that now is the time to buy bonds. And so that was very common, a common view a couple of weeks ago. And what we've seen in the last couple of weeks is the 10-year Treasury note moved very quickly from 3.5% almost back to 4% again. This really just highlights that your entry point on these types of positions are extremely important, because if you had bought it a few weeks ago, you would be underwater.
Yes, you're absolutely right. And I think knowing an asset allocation, where you want to position it, is also accepting the volatility that they're going to have at the beginning, right? But at the end, when you look at fixed income, you can look at short-term duration, and that gives maybe a bit more security for these mark-to-market moves, or look maybe medium-term, and you're going to realize quite a good yield and accept that short-term volatility is part of the deal.
And when you mentioned also that you're starting to look at credit spread products, venturing a little bit into high yield, you mentioned double B, also your preferred space to get involved in. How much of that is a credit trade versus a duration trade?
I think credit, per se, in the past few years have been extending their duration investment compared to previous cycle, I would say. So right now you have a good mix of duration bets and credit bets. So, but at the end of the day, when you go into the double Bs, it's a mix of both. I think it's quite different when you go much lower in the credit, in the single B or triple C, where what really matters is the credit.